Hey guys, welcome back to another week of Mortgage Matters in Minutes. I'm your host, Brent Rasmussen, and this show again is sponsored here by Mortgage Specialists. And this week on Mortgage Matters in Minutes, we're going to talk about how do lenders verify income. And this is a very common conversation because as we look at all kinds of loans, regardless of mortgage loans, business loans, car loans, lenders are going to verify income as one of those pieces. Obviously, we also look at credit and assets, but income besides credit are probably the two biggest things that we would look at in order to qualify. And a lot of times clients will call and state, hey, I have perfect credit. It shouldn't be a problem to get qualified. But then we talk about the income piece and maybe there's not enough verifiable or not enough income that meets the rules. So today we're going to chat a little bit about what underwriting requires when we look at the income piece to getting someone pre-approved or to the actual closing table, verifying enough income. The guidelines are kind of stable and consistent through the years, but generally speaking, when we look at all kinds of mortgage loans, whether it's FHA, VA, conventional, they're talking about keeping the income stable and consistent. And stable and consistent might be different in the underwriting guidelines or in the underwriter's eyes versus you as a particular individual. And I know many clients that come to us might state, hey, I bring this much money in. It's regular. Why does it matter what source or what it is and what kind of income makes a difference? And I'll just state it does make a difference for a few different reasons. Obviously, we have to meet all the rules in order to get what kind of interest rate you would like. And also, a lot of the rules are structured around whether the income that you receive is taxable and claimed through the federal government or not. So we're going to chat about many of those different types of income histories or income that exists for different individuals. Generally speaking, we need to always have 2 years of work employment history. And I know this gets thrown out a lot, that someone might graduate from college, start their job right away, and individuals say, well, they don't qualify for the 2 years. 2 years, they consider school, high school, or college to be a part of that 2-year work history. So if you were doing, nothing and not going to school for whatever reason, and then you started your job and you don't have any other work history, we do need to wait that 2 years. But many people have graduated from high school or a trade school or an associate's degree or college or master's or doctorates, okay? So if you have any of that history in your past, you just have to provide the college or associates transcripts of the courses that you take and the grades that you receive, showing that you've put in the time and the effort to obtain that particular 2 years of employment. So that counts. So if we get someone out of school, we're great. So there's many different ways people receive income. After we get that 2 years documented, you can receive income as a contractor, as a W-2 employee. You might own your own business as self-employed. You might be retired and receive retirement benefits or Social Security or disability, or you might receive some kind of a support like disability, or you might receive alimony or child support. So we're going to talk a little bit about each one of those and how they might impact in regards to qualifying for a mortgage loan. First, the most simplest of income is what we call a W-2 employee. We don't just look at your tax returns and look at just the AGI and say, okay, you brought in $150,000. We look at every source of income, and you might have 2 or 3 different sources. You might be a W-2 employee, but have a side painting business or a side photography business. So we look at each one of those 2 incomes completely separate of each other and calculate the income. So first of all, a W-2 employee, what we're going to look at is, are you full-time? If you're full-time, then we use whatever salary or hourly rate is there, as long as you're consistent and your year-to-date on your pay stubs is consistent with what you are actually making. So if you're on salary for $60,000, which might be $5,000 a month, but it's now March and you only have $3,000 of wages, underwriting is going to ask a question of what is going on? Why is your income not at $15,000 as you've been through 3 months of the year? So generally, your W-2 employees are very simple and very easy. Where it gets to be a little bit more convoluted is if you're a W-2 employee and now you have overtime, bonus, or commission. And anytime you receive one of those extra sources of income, underwriting and the underwriting process is going to look at a 2-year average of overtime, bonuses, and commissions. And we look at just that piece. So if your income went up for salary, great. We're going to look at just your overtime bonus and your commission structure separately there again to average that out over 2 years, which is very simple or similar, to being self-employed. And a self-employed means you are a business owner of more than 25%. Being self-employed, you might have multiple partners, you might be 100% owner, but in the essence of being self-employed, for underwriting rules, we need to have 2 years of taxes, generally speaking. Unless you've been doing the self-employed business over 5 years, you might get away with 1 year's taxes. But anything less than 5 years being self-employed, they're going to need to see 2 years of your tax returns. And this is where it gets to be the most challenging because people bring in revenue. They sell a product or sell services and they bring in income, but then they also have expenses and they take those expenses off of the income because they don't have to pay taxes on the amount after expenses. Well, again, for the lending purposes, we're going to use that bottom number, that net income, the number after the expenses. And I know a lot of people don't like that, but that's exactly what's going to happen. So every time we hear someone is self-employed, we really start looking at the income very first to make sure there's enough income after expenses to qualify for the loan payments and current payments they have. There's many definitions of what it means to be self-employed. There's many different forms from the 1040 tax returns, from the Schedule C as a sole proprietor, Schedule E as a corporation, Schedule F if you're into farming. So there's many different schedules and different forms that we look at, but as a reminder, each income we look at separately. So if you have 3 different businesses, we're going to look at all 3 businesses separately to see which one, obviously, there is the each income source and average those out over 2 years. So quickly, we're going to kind of wrap in the last few sets of incomes, which is retirement. And people that are going through Social Security will want to see, obviously, a pension letter or a retirement letter and or that money getting deposited in your bank account for 3 months. Like in Social Security, every year you receive an awards letter. Underwriting will require that awards letter and then also show in your bank statement that you're actually receiving that amount over time as well. Or they're also going to look at if you pull out investment returns or you pull out investment monies throughout time or throughout month or throughout year, they're going to want to see that being consistent over time as well too. Let's talk real quick about second jobs and second incomes. Again, if you're part-time and not full-time, and this is where sometimes we have to always speak with the HR, the human resource department, to find out, do they classify you as full-time or are you part-time as an employee? And so even though you might work 40 hours, you might still be a part-time employee for whatever reason. Or the opposite, you might only work 32 hours, but you are actually considered full-time. So this is where we have to kind of work together many times with the human resources department to have them fill out a verification of employment to figure out exactly what's going on. If you have a second job, generally speaking, you need to be at that same employment for 2 years again, and we average that income over 2 years. Just like being self-employed, if the income goes up, we can average that over 2 years. But if the most recent year is lower than the previous year, they're going to only allow you to use the lower of the two. So it gets a little challenging when we look at these different formulas, depending on what your income level is, to make sure, again, that it's consistent and stable. There's also a lot of times people are switching jobs and receiving a new offer. We can definitely use job offer letters. There's specific rules and timing on when that can happen. But taking on new employment, as long as it's very similar to what you've done, or you have a justification on why that job is going to be better or more engaging for you, we definitely can use that as a source of income as well too. We just can't state, hey, I'm going to be taking this new job, I'm making a bunch of more money, but we have no documentation. We need to get something from that employer that specifically spells out when do they start, what is their income level, what is going to proceed with their job, and is there any reason for them to not be hired? Like they have to pass a drug test, or they have to pass the bar exam, or they have to pass a certain test to become licensed for whatever job they may need to be at as well too. The last few categories we might look at, again, child support, alimony, disability, those incomes as well. It depends on the type of loan that we look at doing. Disability, if it's full-time and you've received it for long-term, we definitely can use that. But short-term disability, not necessarily can be used. But again, when it comes to child support or alimony, we definitely can use that income depending on whether it's an FHA, conventional, or VA. There's different rules there. But because of discriminatory practices in lending, we as lenders cannot ask you, do you receive child support and alimony? You have to provide that to the lender. So if you are watching this video and this is something that you receive income, you'll want to make sure and explain to your lender, hey, I received this much in income, so they can use that in the application. Lastly is the unacceptable income. Any jobs that you receive in cash, under the table, anything that's illegal, gambling, drug sales, you name it, terrorism, things like that are unacceptable. Lately, because of marijuana laws in certain states, any employees for marijuana institutions cannot be used because mortgage loans are written on a federal level than not necessarily a state level. So I hope you learned a lot today about different kinds of incomes. The biggest thing to know out of all of this is that we look at each specific income, and when your lender is asking you a lot of unique questions, there's reasonings why, because there's guidelines that exist that explain exactly how we can use income, when we can use income, and why we can use that income to make sure you don't show up a week before closing and then your loan gets denied because the income is not acceptable per the underwriting rules. So again, I'm Brent Rasmussen. I'm always here each week, 3 o'clock for the Mortgage Matters in Minutes. If you'd like to find out more about us as mortgage specialists, you can always phone call any questions in at 402-991-5153, or you can go on our website at mtg-specialist.com, or again, like and subscribe on our YouTube channel, Mortgage Specialist LLC. Have a great week, and we'll see you all soon. Mortgage Specialists. Driven, trusted, reliable.